Hey, everybody. Welcome back to another episode of the Blackware Intelligence YouTube channel. Hope you guys are all doing well. Today, we're going to continue with our educational series, talking about derivatives, in particular, perpetual swaps, open interest funding, liquidations, and more. Before we get started, really appreciate if you could hit the like and subscribe button. Really helps out the channel as well as kind of pump this content out into the algorithms. And also, let me know what other metrics you want to see covered moving forward. Be that on-chain derivatives or technicals, whatever you guys would like, we're happy to make a video for you. So let's go ahead and dive in today. So first, we're going to start with the basics. What is a future and what is a perp? A futures contract is an agreement to buy or sell something at a predetermined price at a specified time in the future. So futures are the obligation to transact versus options are the right to transact. So there's a little bit of a distinguish there. Futures are the obligation, options are the right. Perpetual swaps are non-expiring futures contracts, one of the most liquid products in Bitcoin, and essentially are designed to mimic spot. And the way that these contracts are pegged to spot is through something called a funding rate, which we'll dive into shortly. The reason people use perps is for two reasons. A, they offer access to cheap leverage, and second, they're extremely liquid, as we mentioned, or they're one of the most liquid products in the Bitcoin market. So what is open interest? Open interest is the number of futures contracts that are open. There is always a long for every short. This is a point that I think gets a lot of misconception on Twitter. Oftentimes I'll get asked, can you show long open interest or short open interest? The answer is no, because there's always two sides to every single contract. With that being said, it's all about trying to gauge the aggression of the market participants that are on each side of the contract. So an example of this would be, let's say for one contract that's open, there's a retail degen that's on the long side that's just looking to get access to cheap leverage. They're extremely bullish and they want to speculate that Bitcoin is going to continue to appreciate really aggressively, and they go on high leverage on a perp contract. On the other side of that, on the short side, you could have an arbitrager or a market maker, which is just another way of saying liquidity provider, on the short side. And they may also be long spot. So that means that they're delta neutral, or in other words, they have no directional exposure to the market. They're just there to harvest that funding rate. And we'll talk about the funding rate in a second. But just to understand this, just realize there can be, a speculator on one side of the contract, and on the other side, there could be a market participant or an entity that's completely non-directional in nature. They could just be providing liquidity, or they could be trying to arbitrage a funding rate in the market. So with that being said, let's look at two examples of open interest. So first of all, we just have the value of open interest in USD terms. As you can see, whenever open interest gets really high, that's in kind of areas of speculative kind of euphoria for the market. You'll see April of 2021, as well as November of the end of last year. We had these two big spikes reaching actually higher levels than April of 2021. This is the metric that I personally prefer. So this is looking at open interest relative to Bitcoin's market cap. So you might ask, why is this important? The reasoning is because you need to gauge how many contracts are open relative to the size of the market to understand what weight that derivatives have on the market relative to spot. So an example of this would be, look here at the end of summer, right? When we look at this metric, you see a very large buildup versus in just USD terms, it's not that substantial, right? But you would need to know this because we had this large short squeeze off the lows, because there were a lot of contracts building up relative to the size of market cap. And this is why I prefer to look at this ratio of open interest relative to market cap. So you'll see these big moves following these big moves up in open interest relative to market cap. And that doesn't always mean long squeeze. Generally it does, because Bitcoin has a kind of a long bias, right? But you can also have these short squeezes as well. You'll see, at the bottom of summer was probably the best example here on this chart. Long squeeze here, here as well recently. And as of late, we've got just this large buildup that's just kind of chilling. So we kind of talked briefly about funding rates. Let's dive into what that means and what's going on behind the scenes in terms of the dynamics that are making up what a funding rate is. So the funding rate is based on the premium or discount. So now you're going to ask, so Will, what is the premium? What is the discount? There's a lot going on here. The premium or discount is the difference between the price of the perp and the weighted average, or what we call the index price the weighted average of all major spot exchanges. So the premium or discount is calculated by taking the perp minus the weighted spot index price, or the difference between the perp and the weighted spot index price. And depending on if the perp is trading above that index price or below it, you get the premium or the discount. And so while calculated slightly differently, this is what the funding rate is based on. With that in mind, on most exchanges, this funding rate is paid out every 8 hours to incentivize entities to take the other side of the trade. Because again, this is how the contract is pegged to spot. So you need to have an incentive for people to keep that contract pegged to spot as much as possible. To go a step further on this, before we go to the next slide, just want to throw this term out there because you'll see it on the next slide: arbitrage. Arbitrage is the capture of market inefficiencies. Generally, arbitrageurs are delta neutral, which again means that they have no directional exposure, and they're also USD denominated in crypto. So some continuation on funding rates. With that in mind, what we just talked about. So you'll probably say, what if everyone's bullish, right? And no one wants to be directionally on the short side? An example of this would be early 2021. Well, the answer is what happens is you have, again, USD denominated arbitrageurs that are just looking to get yield. They're just looking to capture yield. And when funding is extremely high, they can arbitrage that yield and just capture that funding rate. An example would be, they can long spot and short the perp and just capture that funding rate every 8 hours and harvest that. And so again, these are mostly USD denominated arbitrageurs that are looking to kind of maintain this peg by capturing that yield. Example of arbitrage would be if funding is positive, an entity again can long spot, short perps, capture the funding rate every 8 hours. This is very similar to like a cash and carry trade for anyone in traditional finance. That being that you're long spot, short the futures contract when the futures curve is in contango. Contango just means that the futures curve is positive sloping. Backwardation is when the slope is negative. So, when the 1 month contract is above the 3 month contract and the 3 month contract is above the 6 month. Contango would be when the 1 month contract is below the 3 month and the 3 month contract is below the 6 month. Right, so you have a positive slope out there. A very, very similar concept here. When someone's looking to harvest, a positive yield, you can just long spot and short the contract. So how do we apply funding? We talked about what funding is and kind of what the dynamics are behind it. So let's first talk about like two misconceptions that I always see, mostly on Twitter. Negative funding does not always mean shorts. So again, it's just based on the premium, which is the difference between the perp price and the weighted spot index price. So while it could mean that there's shorts, it could also just mean that spot is simply bidding, pushing the index price up faster than the perp price. And that could be causing that positive premium, therefore, negative premium or discount or negative funding. And then the second case would be that positive funding does not always mean longs. It could simply mean that spot is selling off more aggressively than perps, pushing down the index price quicker than perps. There's more situations than just these two that could indicate why funding would be negative or positive. The point I'm just trying to make is that positive funding doesn't always mean longs and negative funding doesn't always mean shorts. So maybe there's going to be some more sophisticated people listening to this and they might be getting on me about missing some nuance. Again, this is just a one-on-one, so I'm just trying to use basic examples to help you kind of understand these concepts. High level here is just that. Negative funding doesn't always mean shorts. Positive funding doesn't always mean longs. So with that being said, to apply funding, we're going to look at twofold. So these are the two areas that I think are the best application of funding. First of all is looking at regimes of funding, and the second being looking at dislocations between funding and price action. And we'll look at these examples on these next few slides because I think looking at charts is probably the best way to kind of visualize this. So now we're looking at regimes of funding. So again, these are just prolonged periods of time where you have either positive, negative, or mixed funding. And it's also important to take this into context with price. So if we look at after the kind of March 13th COVID crash, if you will, we had this grind off the lows. Meanwhile, funding was deeply negative. So showing you kind of this disbelief rally. After this regime of negative funding, kind of had this mixed chop around just from kind of May to July, August area. Heading into September, we had this push up to about 10 to 12K. Traders got extremely bullish. You saw funding really spiking here, this little regime of positive funding. After that, had this 20-25% move down, wiped out a lot of this this kind of froth in the market, if you will. And then we had this regime of mixed funding, which is showing kind of disbelief because traders are saying, I'm not really sure, right? Here they felt very confident. Now they're saying, I'm not really sure. We had this move down. I don't know if we're heading straight to all-time highs anymore. And generally, whenever you have perps unsure or ideally offsides, that kind of sets up a move to the other way. And with that, we had this grind up into November, October, November, and entered this massive regime of positive funding. Now, again, generally these regimes eventually do switch to the other side. But when you have spots supporting them, you can have a prolonged regime like here, where we had the grayscale, grayscale basically flowing into spot every week, continuing to, apply that spot bid, which continued to prop up the market and basically bail out all of these speculative longs that were in the market. But with that being said, I do think the longer that you're in a regime, the more aggressive the move is likely to be once you come out of it. So as you can see, although they basically got bailed out for 4 or 5 months here, once we finally flipped out of this regime, you saw an aggressive move down in the middle of May. We had a negative regime over summer. And then as well, we'll touch on this in a second. This kind of ties in both the regimes and the dislocation concepts. But you'll see we were in this negative regime, and then funding started to go further negative as we started to move up off the lows, which we'll look a bit more granularity in a second when we start talking about the dislocation examples. After that, we had a positive regime, a wipeout after this move up to 53, came back down, set this double bottom around 40K, and then another positive regime up until the wipeout at the end of December. And we're kind of chilling in this kind of mixed regime now. So with that in mind, so we just looked at regimes. I kind of talked briefly about this dislocation here at the end of summer. I think this is probably one of the best examples to look at. So ignore kind of my tweets, like half serious, half not, but just look at the chart. So as you'll see this on July 25th, as Bitcoin started to grind up off the lows. So this is when we kind of grinded down off the 28, 29K, reached about 32, 33K. You saw funding going further negative on this move up and extremely negative on this push up to around 34, 35K. So basically it was just saying there's a squeeze in play because funding is strongly dislocating from price here. And we did get a massive short squeeze following this up to, I think it was like 48K on Binance in about an hour or two. It was, in my experience in the market, the largest short squeeze that I've personally seen. And then these are a bit more intraday, I guess, examples. So here I was just saying market cap relative to open interest was rising. We had positive funding. I thought we were going to get a shakeout before we move higher. We saw that shakeout, price grinding down and funding rising. So this was I remember a pretty clear example because funding was at like 200, 250% APR, which is a massive payment to having to be paid every 8 hours. Because even if the market is going sideways, it's still eating into your P&L. Right. So essentially anything aside from the market mooning, you're basically getting your P&L eaten into. And then we did get this wipeout. I don't know exactly what price level this is that we wiped down to. And then as well, third example is just that funding was rising and especially on Bybit and Binance. So this is a bit more nuanced. Maybe we'll cover this in another episode, but you can also look at intra exchange funding. And generally speaking, this is a big generalization, but when you see like, Bybit going aggressively in one direction and like a Deribit or FTX, strongly in the opposite, probably want to be on the side of Deribit or FTX opposed to Bybit. That's just the example I was using here. Definitely I know I'm kind of shilling my little Twitter calls here. Definitely not right 100% of the time, but these are just, some of the better examples that I've used in real time. Now we'll talk about liquidations. So not to be confused with stops. Stops are basically just the invalidation prices that are set by traders for them to get out of the trade. A liquidation is a forced order sent into the market when an entity's collateral no longer sufficiently covers their position. There's just some quick math on liquidation prices. So let's say you're 5x long, price only needs a 20% move to wipe you out. If you're 10x long, only needs a 10% move to wipe you out. If you're 25x long, only needs a 4% move, 50x, 2%, and 100x, which is extremely degenerate, just a 1% move. Definitely don't suggest anyone listening goes up to those kind of higher echelons of leverage. I personally stay far away from that. And then lastly, a liquidation cascade. So when stops or liquidations trigger the next entity stop or liquidation, you get this basically cascade effect. And this process continues until either price finds sufficient order book liquidity. So if you're having a long liquidation cascade, will continue until you find a large pocket of bids, or when a bid steps in the market and just absorbs those liquidations. And that basically dampens that move down and soaks it up and absorbs it and allows the market to kind of balance out. Or you have events like March 13th, 2020, where that just continues until Bitcoin goes down 50% and BitNEX has to turn off their liquidation machine. So generally speaking, though, these are forced events. These aren't events of informed flow, right? So informed flow being someone who takes into account information that they're given on the market and then makes a decision. Liquidation cascades are just forced sells that are going into the market, or forced buys in terms of a short squeeze. That can also be a liquidation cascade. Continuation on liquidations. So again, liquidation cascades can occur to both the long and short side. These events wipe out excess leverage or aggressive open interest that is off sides. These cascades will push the perp price below the index to the long side, which does cause negative funding. So if you look back, let's go back to this chart. So if you see this big spike down in May or as well in March of 2020, these big spikes are just from the liquidation cascade itself, just continuing to push down that perp price because these are all forced sells. And by definition, that's pushing the perp price below the weighted average spot index price. Because these orders are forced and not informed flows, we just talked about, we tend to see short-term mean reversion after these nukes. An example would be in May, after that push down to 30K, we had this kind of intraday rebound to about 42. And that's just because these moves in either direction, the example we're talking about in May was a down move. They really get exacerbated because it's forced orders that are going into the generally thin books, and that really causes deeper moves than you would naturally see based off of informed flow. And then lastly, just kind of throwing this in here for, I guess, long-term investors, that spot BTC in cold storage cannot get liquidated. So if you have your Bitcoin in a cold storage wallet, have your keys, that cannot get liquidated. And here we have a chart of long liquidations relative to open interest. So you'll see these spikes coinciding with these wipeouts of OI here. Here's the big one in May. This move after 53K, this recent move in December, and this one about a month ago. You will see during this wipeout, you didn't have a spike. That's just because this is only long liquidations. So if I had thrown in short liquidations, you would have seen another substantial spike. This is just only looking at long liquidations though, because this was a short squeeze. And yeah, so for our conclusion, just to kind of wrap everything up, I know I kind of bounced all over the place, may have to listen back to this. But in essence, perpetual swaps play a large role in the Bitcoin market and price discovery. Open interest tells you how many contracts are open, but not the risk of those contracts. So to do that, we look at the context of open interest. So this is something I kind of missed talking about earlier. I should have talked about it when we were on the open interest slide, but not only can we look at premiums and funding rates, we can also look at the context of where open interest comes into the market and also how it behaves with price, right? So if we run substantial high and you don't see a large amount of open interest get wiped out, there's probably a lower probability that those are aggressive shorts. Or, to the flip side, if we run, a really clear low, if we run like a range low and you don't see any real liquidations, that open interest probably isn't aggressive to the long side. And so you will see these kind of liquidity grabs by, in my opinion, market makers that are trying to figure out the aggression of the open interest when we swing below range highs or range lows. And those can kind of give you clues as to, where open interest lies. An example of this would be on that move up to 52K about a month ago. I think we moved up to about 52,500. That was very interesting because at the time I had thought a lot of that was shorts, aggressive shorts. And when we swept the range highs, we didn't get a lot of liquidations. And I said, this is really strange because if it was aggressive shorts, you would have seen more licks at that kind of range high retest. And so we tested that liquidity up there and it didn't appear that open interest was aggressively to the long side. And that kind of had me change my thesis in the moment because based off the context of how open interest was behaving with price action, it was telling me something different than what I suspected. And then again, in combination with the context of that open interest, we can look at premiums and funding rates, which, as we talked about, are based on the premiums or discounts. Liquidations are forced orders. Liquidation cascades occur when large amounts of liquidations or stops get triggered that take place into thin liquidity, which exacerbates the moves down. So an example of this would be if we look at the end of December, this big puke down. This was on a Friday night with extremely low liquidity. Remember also at the time, you can look at like bid ask depth on the order books, and that was like extremely low. So there just weren't that many bids in the books to absorb any type of move that was going to occur. So when you have thinner order book liquidity, if you have a liquidation event, that's going to, be even worse versus if you have like a really strong, bid side and you have a massive liquidation event. Let's look here, for example. This was the largest spike on the screen, but it wasn't necessarily the largest price move down because there was still a good amount of bids in the order books that were able to absorb this. So take into context as well, what the order book depth looks like. And then lastly, derivatives data should be taken in context with price action in on-chain. I think this is probably the most important point on this slide. Maybe some people disagree that don't pay too much attention to on-chain. I do, but definitely price action. We talk about several examples of that, but yeah, definitely need to pay attention to all of these factors in combination with, is price at major support or resistance? And that can kind of help you form kind of a contextualization. I don't even know if that's a word, but it sounded smart, of kind of what's going on in the derivatives market. With that being said, I hope you guys enjoyed this. I hope you got some value out of my rambling, and I hope you guys look forward to the next couple of videos. Let me know what other metrics you'd like to see covered, be that derivatives. We can go way further in depth. This is just kind of a perpetual swap 101. But if you'd like to see more nuance on this, definitely can do a follow-up episode. And on-chain wise, let me know what other metrics you'd like to see in that realm as well. And this has been one of the topics that I've seen most requested. So I'm really happy to finally get this video out, just so, myself and everyone else has something just to refer back to. And yeah, hopefully this helped. And I'm learning just like you guys, and will share my learnings with you. And with that, I hope you have a great day. Hope you enjoyed, and I'll see you in the next one. Take it easy, guys. Bye-bye.